Hi, everyone. Welcome to Reporters Roundtable. I am Rafe Needleman in San Francisco, and it has happened. Facebook is now a publicly traded company. Biggest internet IPO ever. Facebook is going public today and is becoming a company worth over $100 billion. And this just 8 years after a start in a humble Harvard dorm room. Facebook's IPO will change the economics of the internet. Not exactly a cash-poor company before the IPO, the new public funds lining Facebook's pockets will mean the social company has extra money to launch new projects and buy up companies that mesh with its mission or compete with it. Will the frenzy for Facebook stock last? Can a social network make money the way Google does, which is hand over fist? And is this a stock you should be buying today? All right, guys, we're here at Reporters Roundtable, a special live show. We haven't done a live show in quite a while. We're going to be talking about this IPO, should you buy it or not. We've got a couple of great guests to talk about it. First of all, Jill Schlesinger from CBS Money Watch is joining us over Skype. Jill can help us sort out the pros and the cons for investors interested in this IPO. Thanks, Jill, for making the time.
Great to be with you.
Andy Ratcliffe is the CEO of Wealthfront, an internet-era investment advice service. I hope I got that right.
Yes.
I've covered the company. It's fascinating. Andy's a venture capitalist at Benchmark Capital, also teaches about entrepreneurship at the Stanford Graduate School of Business, and he wrote about Facebook's IPO for CNET on CNET News in February. Andy, thanks for making the time.
Thank you.
Joining us also over Skype, Tom Merritt, the host of the Tech News Today show on the Twit Network, of course, also a former CNET podcaster here for Buzz Out Loud. Tom, thanks for joining us.
Always good to be with you, Rafe.
If you have a question about this IPO for this panel, send it to us. You can send me an email, roundtable@cnet.com, or send a tweet. Use @Rafe in the tweet and the hashtag #FBIPO, and hopefully I'll see it. But we're going to get started here with another guest, a little Facebook stock weather report. Paul Sloan is joining us here. He is our exec ed who has been a man on the spot for IPO coverage. Paul, give us a sense of what's happening.
A weather report?
Traffic and weather. Here's what does this mean?
What does it mean?
Explain it to us. How's the stock doing?
You know, the stock is up modestly, but you have to think that the bankers are in a little bit of a panic mode. I mean, the bankers, I think, and you can tell me, Andy, if I'm wrong, like to see a little more of a pop, and they can't exactly support a deal when it's this large.
So the stock went public at 38.
Went public at 38,
It's
which was
trading
higher than expected. They had raised the range, I guess, a couple days ago. Demand was off the charts. You know, people tried. There was all kinds of skepticism. You know, bad news from General Motors saying the ads aren't working, and a lot of insiders, taking money off the table.
Mm-hmm.
And yet, and the demand has been really strong, and so they pulled off an incredibly successful IPO. It just hasn't popped out of the gate as in a 1999 style.
No, so the stock right now is at 40.83, which is a 7.4% pop since opening. Who makes money when a stock pops up, Andy?
Well, the underwriters typically place the stock with institutional investors to begin. And the intent is to give the institutions enough of a toehold position that they'll want to come into the market after the IPO goes effective and buy bigger positions. But some of the institutions run so much money that it's not worth it even to have that toehold position. So they're going to flip the stock, and they're going to be the primary beneficiaries of that initial rise in the stock.
So, Jill, with performance like this, up right now, we're at 40.99, up 7.87%. Boy, this is so exciting. I can barely contain myself. Jill, what does this mean? What does a 7.8% rise in a internet IPO mean for the retail investor?
Well, I mean, I think it's sort of interesting because most retail investors did not buy in at 38. So we always used to say this when I was a trader. We would call them the dumb money. They got in after the fact. They're the ones who probably bought the shares at 42, 43 when it popped earlier. Mm-hmm. But for the most retail investors, honestly, chill out. I wouldn't touch this thing today. I'd let things settle down. Or, by the way, I just buy an index fund, which is going to have Facebook in it, and just know that even in the last 7 deals done in the past year, while the stocks have gone up a lot in the first day or two, they're down 11% on average a month after the IPO. Wouldn't that be fascinating if Facebook actually fell below the offering price? It would be like all the hype for nothing. It would be kind of fun, right?
Is that a big deal if Facebook falls below offering?
It is for the media. It isn't for the day-to-day running of the company.
You're the only person here, Andy, who does not have a media job.
Well, I think that it creates some artificial pressure for the management team, that they have to field a lot of questions about why is the stock below the offering price. But if you think about it, when you sell stock, you want to sell it at the highest possible price to give up the least amount of dilution. And so there's a trade-off between selling it so high that the stock might go below the offering price, and then not having the pop because people think, well, if it doesn't go up 50%, it wasn't a successful underwriting. You know, Google was perceived as a not successful underwriting because the stock didn't pop on the day of the IPO. They did pretty well.
Now, Tom, you've been in this industry almost as long as I have. You've been tracking this stuff forever. How exciting, how important do you think this IPO is for technology companies?
Well, it's one of those benchmarks that, you know, we've seen Zyngas and Groupons and Zillows, but Facebook is one of the big companies. It's the one you talk about all the time. It's up there now with Google and Apple and Microsoft, at least in being newsworthy and being of interest. And it's got 900 million users, so it's huge. I think a lot of people were keeping their eyes on this to see how a big company like that is going to fare in the current IPO market when we've seen the Groupons and the Zyngas and the Zillows pop out, go way up, and then drop below their opening prices, as Jill mentioned. And would Facebook, with their momentum, be able to buck that? And we've seen a lot of mixed signals. Facebook raising that opening price, but at the same time, General Motors coming out just a week before the IPO and saying, well, we're not going to spend any more advertising money on Facebook.
Now, I may have a unpopular view here on this particular IPO, but I would like your comments, this whole panel's comments on this perspective, which is that if a stock goes out at 38, jumps up to the low 40s, and then hovers around 38 for a while, it seems to me that that indicates that the stock was accurately and correctly priced, that we don't want to see a stock doubling or even going up 50% the moment it goes public. That means that there has been money left behind, that they misjudged what the company was worth. So I look at this and I think the underwriters did a good job. Andy?
You must have worked for an underwriter.
I've never worked for I know nothing about economics. I am a journalist.
I think that's a very fair statement. And the only thing that keeps companies from pricing significantly below the fair value is they want to reduce the chance that sometime in the future the stock trades below that price. But I completely agree with you, Rafe. The fact that the stock is up 8% is a testament to the quality of the job that the investment bankers have done.
Okay.
Yeah,
Jill?
I mean, look,
Paul? Jill, sorry.
I think it's not a bad thing. I will say one thing that, you know, look, they did raise the range. So if we had gone on the original range of the stock offering before they went on the road show, it would have been, you know, we would have been talking about a 20-30% pop. So I think that probably they did price it right. I'm sure that everybody at Morgan Stanley is dancing a jig right now. You know, they're going to collect $176 million of fees to split up among those 33 underwriters. So I think probably after Facebook employees and early investors, the investment banks are going to be the happiest today.
I mean, for sure, it helps that it's priced right. When I said there was panic on the investment bankers, I mean, earlier today it was trading right around 38, 39. It wasn't exactly a big pop. I think that obviously it was a huge success for Facebook. I mean, it seems perfect for them. But I think from the bankers' perspective, they do not want to see it falling lower. I mean, it just makes they want to see that the excitement's out there.
Rafe, can I give you one other perspective? That if you're a consumer internet company or a consumer company in general, and you're not on everyone's radar, then having a big pop in your stock price is a really good thing to have happen. It means that you left a little money on the table, but the marketing value of having a stock that goes up 50 or 80% is invaluable. It's priceless. And so if I'm a much lesser known internet brand, having everyone report on the big pop in my IPO price will get me press that I never could have gotten otherwise and can build momentum in my business. Now, if I'm Facebook, I don't need that.
Right.
So I have an incentive to price it much closer to the fair value because I don't really need that pop as much as a lesser-known brand.
Now, everything we know about Zuckerberg says that he is very hands-on with stuff that many entrepreneurs and CEOs would not be. For example, booting the lawyers out of the room when he was doing the Instagram deal. Tom, what's your sense of how hands-on this particular CEO is with something as arcane as dealing with the stock market?
Well, I don't have much of a sense of it directly. I don't have any direct contact with Facebook, but just from watching the road show and the controversy about the hoodie and him sort of bowing out of a couple of the appearances, it seems like he's really more concerned with coding. Last night they had a hackathon to lead up to the IPO. He wants to run the company. He wants to work on Facebook, and this is somewhat, at least it seems from the outside, a bit of a distraction for him. That he's happy, he's glad that they're public and they're bringing in the money, but he has consolidated control of this company. Remember, those Class B shares that current owners have pre-IPO have 10 times the voting rights. He's going to have, by different accounts, 54 to 56% of the voting rights over the company even after the IPO. So I think this is something he felt he had to do. He put it off as long as possible, and I bet he's glad he's done with it now.
So you're never, once you go public, that's the deal with the devil. You never get out of that one, though, do you?
No.
I mean,
not at this size. They're not going to bring it back. They're not going to ever have the money to buy it back from the public again. So forget about it.
How is Facebook going to change now that it, despite Zuckerberg's ownership of all the voting rights, essentially, how must Facebook change now that it is a public company?
I don't think it needs to change at all. I think there's this misperception that in order to run a public company, you have to satisfy the shareholders who bought your stock last week. The best CEOs I know, the most successful ones who've been able to transform their companies over time, run their public companies like private companies. They worry about what's best for the company over the long term, not what's best for the people who bought the stock yesterday.
Would you consider Google an example of a company that does that?
Yeah, I would think Apple is an example. Veritas Software was an example. Adobe was an example. So they do what's right for the long-term business, and they don't pay that much attention to what the short-term investors want to do. And I don't think that's a breach of one's fiduciary responsibility just because you ignore the short-termers. There are a lot of constituents that you have to worry about.
Now, speaking of short-term, one of the very interesting news items that broke this morning after Facebook went public was that Zynga stock fell off a cliff, and in fact, it looks like the stock was halted. I don't know if it's still halted for a while after dropping 13%. The triggers went off, and they turned off trading on Zynga. Why would a Facebook IPO cause Zynga to drop when these two companies are basically, from my estimation, two sides of the same coin of the social network business? I'm opening this one up for speculation because I'm fascinated by this.
Well, I mean, there's only like one possibility for. I'll put my trader hat on for a second. I mean, there is a possibility that people are basically putting a spread on. I'm going to go short Zynga. I'm going to go long Facebook. Facebook's a better value for me, and I put on a great spread. And a lot of times, it's like saying I'm going long Coke and short Pepsi, and they think there's better value in Facebook unless there is news about Zynga that we just don't know about.
Nobody. Okay. All right. So let's see what's going on right now with the stock. This is becoming boring. 6.3% up.
You need
40.
timpani.
I need a timpani. Yeah.
Andy, I totally agree that and we've talked about this before, that really it's about leadership, and a good leader can navigate the company even if it's public and doesn't have to necessarily cater to the short-term interests. But surely when you have so much of your company's wealth among your employees tied up in restricted stock and over time, I mean, it's helpful if the stock does well over the next 6-8 months.
Well, this is one of the interesting things here. How do you manage a company that goes public and makes so many people so wealthy? Now, granted, they can't cash out today, if I'm not mistaken. Let's talk about what it must be like if you're an engineer at Facebook and you've been there for 3 years. You now have stock that is worth house money. It's FU money, right?
Yes.
Most of them. How does Facebook keep these engineers motivated? And if you are one of these engineers, and if if anybody here has had a windfall at a company, how do you manage things? Jill, Andy, I mean, what's your advice on that?
I can tell you what best practices are, and I think that Facebook is doing a great job at the best practices.
All right.
Number one, you spend a lot of time preceding the IPO, explaining that the IPO is just one step in a long-term marathon. That it's like, when you graduate from college, it's called commencement. It's the beginning of the next stage of your life. And I think that the really good leaders position IPOs as commencements, whereas many individual investors view it as a final outcome or the ultimate
It's
milestone.
called an exit for a venture
It's
capitalist.
not. No, it isn't. No,
we hear about the exits all the time. You're saying that the journalists, the press, made that up?
No, but I can tell you that having been in the venture business for 25 years before teaching at Stanford and starting Wealthfront, we never called an IPO an exit. Never.
You know, I have a different perspective on this because when I was an investment advisor in New England, I used to get hired by some of these tech companies in 1998, 1999, and 2000 to come in and do face-to-face meetings with their employees who were about to become very wealthy. And the great companies, what they would do is they'd take me, someone like me, and they'd say, I will pay you by the hour to sit and talk to these people about how they should not squander their newfound wealth. And it was amazing. You know, of course, some of these guys would go out and go nutty, right? They're going to, you see a parking lot full of Porsches, but, you know, that may not be the culture out there. But it was really astounding to see the real differences among the types of employees. Some people just thought, yes, I've just become rich. I'm going out. I'm going crazy. But I would say that especially as you got later in the cycle, people were scared. They said, I don't want to squander this. Please help me. And I think companies, and especially a company like Facebook, there are going to be so many people who are worth so much money. You can imagine the pressure that I would imagine that you're carrying with that. You know, if anyone who's watching who's got in this position, don't blow it. Make sure you secure your financial future and, of course, buy something fun. But it's kind of like a lottery in that way. If you're going to hit it big, put the money aside that you need to do everything you want to do, your kids' college, you know, your own retirement, and then, of course, have some fun.
You know, remember, a bunch of Facebook employees or former employees have sold stock. They sold it on second markets. And they have not, by and large, done ostentatious things with that money. And I think that's a proxy for what you're going to see from the people who remain as employees and are likely to get some liquidity after the lockups are released in 6 months.
It's even better. They've started companies or they've invested in other companies.
Absolutely.
Now, that is one of the great things about a big IPO and about a lot of people having excess resources to do things like, I mean, if you're Jeff Bezos and you've got a lot of excess resources, you should launch a space program. But if you have maybe, you know, only six figures or that, you can take this money and invest it back into the technology economy. And that's a great thing. I mean, this is how the boom and bust cycles work, and this is where entrepreneurship comes from. It's all these angel investors, right?
Well, it's not necessarily a great thing. If you look at technology successes over the last 30 years, the amazing thing is the number of companies that achieve great success is incredibly consistent. I did some research in 1995 and updated it in 2000 for some presentations I had to give, where I found that only 15 companies, plus or minus 3, are created every year that at some point in their life reach 100 million in revenue. That's it, nationwide. And it doesn't change any year. But so the number of companies started is like a sine curve. It oscillates. So I think we're going to see a lot more money coming into the angel market as a result when the lockups come off. But that doesn't mean we're going to see more successful companies. It just means we're going to see more failed companies.
Well, it depends how you define success. It depends how you define success, right? Instagram would not have made it onto your list.
Agreed. But I'm talking about, but for the economy in terms of jobs and such, the number of companies that achieve critical mass or real success is very consistent.
Right.
And having more angel money come in isn't necessarily going to drive more innovation, as many people have posited.
Right. But Instagram type successes drive a lot of those angel investments.
Let's begin to wrap this up by talking about where Facebook does need to innovate and where they may be making acquisitions, whether they're actual company acquisitions or what are called acqui-hires, buying a small company out just to get the engineering talent there. Mobile. Tom, Andy, Paul, Jill, anybody want to talk about how is Facebook going to manage the move from the social era, which we're in, to the mobile era, which we're moving into?
Yeah, that seems to be the common consensus, is that Facebook needs to be in mobile. In fact, there was an interesting Forbes article at the end of April saying that Facebook and Google are fighting the last war, that they need to be looking farther ahead. And Facebook struggling with mobile is evidence of that. I think what we're seeing with the Instagram acquisition and with the acquisition of the Lightbox folks recently is what their strategy looks to be, which is let's go out and find people who are really good at mobile, bring them into the company and let them loose and see what they can do. Google just did that to very good effect with Google Plus. Everyone suspects that pulling in Kevin Rose's team from Milk is what brought out the new Google Plus mobile app, which has been a fantastic improvement over what they had before. So I would expect to see more of those kind of hires, as you say, from Facebook.
And the other thing we hear that is a big area of expansion, obviously we know about this, is global presence. The news came out the other day that there will soon be more Facebook users in India than there are in the U.S. So how important and how does Facebook make the transition to being a truly global company where the United States is just one of several markets?
They did a long time ago.
Yeah.
Yeah, but
There are
I,
many
What does
more-
it mean for us here in the good old U.S., though?
Well, but I
Jill.
think that there's a little bit of an issue there, okay? Because you might have users, but you need consumers. That's what they need. And what we know is that some of those economies where there's been expansion with Facebook, those people aren't necessarily consumptive. And especially like in a place like China or India, where they are more of a saving society than a spending society, we're waiting for them to become more bigger spenders. And I think that is the next frontier. But right now, let me tell you something. Chinese people save 40 to 50 cents of every dollar they make. They're not clicking on ads on Facebook and buying crap on the internet.
Well, let me give you a different perspective. So everyone's talking about mobile, and I think it is critical that Facebook succeed on mobile. But we're forgetting the fact that they own the plumbing of the internet, the new plumbing. Look at Facebook Connect. Think of how many websites use Facebook Connect as the way to get new people to come use their sites. If Facebook wanted to, they could charge a penny a login, and every single website, I know I would pay Facebook to
Bite your tongue.
Well, we would.
But you're right.
But everyone's forgetting this. And if they charged a penny a login for Facebook Connect, which makes it a lot easier for me as a website operator to offer convenience to my users, that would be $1 billion in operating profit tomorrow. So lest we forget how much of an asset Facebook has built that will continue no matter what happens in mobile.
All right. Finally, advertising. This is where these companies make their money. This is why Google is a $40 billion revenue company and Facebook is under 2. Paul, how does Facebook turn it around in the advertising space?
Look, I agree with Andy. I think it's a mistake to think of this only as an advertising play. I think there's so many users and there's so many different opportunities, whether it's expanding Facebook credits, whether it's using mobile to get into offers like local offers, whether it's Groupon type offers. There's all kinds of ways, whether it's charging for Facebook Connect, whether it's creating an ad network outside of Facebook, which a lot of people have speculated could happen, where they create ads where maybe you go to the Washington Post site and you see an ad for a restaurant and you're like, my friends like that one. Mm-hmm. And so there's all kinds of ways they can not only boost their advertising revenue but get other revenue. The question is how long it'll take to do it and whether they pull it off.
Clay Christensen wrote a book called The Innovator's Dilemma, which really made an impact on me. And he coined the term disruptive technology, which is often misused. But disruptors always sell their product for a lower price, but they sell more of it. So if you think about this in Honda motorcycles versus Harley Davidson, mini mills, steel mills, if you look at Facebook ads, Google text ads versus Yahoo display ads. Well, Facebook ads have a fraction of the price of a Google ad. So people always think, they're a terrible advertising company. Well, at the time Google went public, at the same age, I think Facebook has more advertising revenue than did Google. So turnaround, why are we talking about turnaround if they're doing better than Google did at the same age?
That's one way of looking at it. Excellent. Hey, sorry? Jill, any final advice for people who are looking at this stock hovering around $41 and thinking, oh, I got to get in now before it goes up to 60? What do you think, Jill?
Yeah. I think just chill out. Really, there's no reason to make a trade now. And by the way, for most people who are out there managing their financial lives, you got to remember, you're not building a portfolio of 50 stocks. You're not a money manager, and those guys can't even beat the index. Stick with the index. And by the way, I don't want to be a buzzkill. I know everyone is so psyched about this. There is a huge problem lurking in our markets right now, and it's called Europe, and it's called Greece. So before you go jump in and start getting all wacky about Facebook, make sure you've got a diversified portfolio, because it is going to be bumpy in the do
And the best place to do that diversified portfolio is on Wealthfront.
I was waiting. I was waiting.
I do want to wrap up here. And Andy, since you mentioned that, thank you for your time. Your payment for your time is, tell us about Wealthfront really briefly, 10 words or less.
Well, we're an online investment management firm that helps young people initially who work in technology to have their money managed in a diversified portfolio of very inexpensive index stocks of the type that Jill described. And we do it at a tiny fraction of the minimums of the high-end wealth managers like Goldman Sachs, and for a tiny fraction of the fees.
Thank you. Always great, Andy, to hear your input on this stock and others and the market in general. Andy, of course, is the CEO of Wealthfront. Tom Merritt is the host of Tech News Today. Tom, any final words on this or other exciting public company news?
Well, Eric Mack has a great article on CNET today about a programmer who's doing Facebook IPO day closingprice.com. If it's already at the end of the day, then it's too late to look at it. But by scraping Twitter, he's predicted that the closing price will be $54. But then we also have John Perry Barlow of the EFF predicting that the stock will close at $32. So I guess by the end of the day, we'll know whether Twitter or John Perry Barlow are better at predicting the future.
You know how to make money on Facebook stock? Is run the betting pools. Don't touch the money. It's not the stock itself. Jill, you're at CBS Money Watch. Tell us what you're up to.
I am covering this story. I'm covering Europe, and I'm really all over this JP Morgan Chase story, which is juicy and gossipy here in New York. We love that kind of story. And you can follow me on Twitter at Jill on Money. And, if you got a financial question, I do host a weekly call-in radio show, kind of like Dr. Fraser Crane for your money. So let me know if you got a question.
My money is neurotic. I'm telling you that right now. Paul Stone is executive editor here at CNET News. Paul, what's on for today?
Facebook.
What's the okay?
Whatever.
You can find Paul's stuff.
It'll be over soon.
It will. Whew. Goodness. All right, guys. Hey, everyone, thank you so much for making the time to come in. Thanks all for watching. Thank you, Kelly, for producing. You can find all the news of Facebook and all those other tech companies on CNET News. I am Rafe Needleman. This is Reporters Roundtable. Thank you.